So think about the last time you pulled into a massive retail plaza, just to grab a coffee or maybe hit the gym.
Yeah, right.
You look around and you see the concrete, the parked cars, maybe a drive-through lane wrapping around a fast food joint.
Mhm.
It's a physical environment built entirely for convenience. But to institutional capital, that exact same physical space is, well, it's something completely different.
Oh, absolutely. It is an invisible, highly calibrated financial instrument. I
Right.
mean, it's essentially a machine designed to capture yield. And the gears of that machine, like the lease structures, the
Mhm.
zoning arbitrages, the calculated tenant psychology, all of that is entirely hidden from the people actually parking their cars and spending their money.
And that is exactly the hidden machinery we are exposing today in this deep dive. We have a genuinely fascinating source to work through. It's an April 25th, 2026 market breakdown called the EBG Listings of the Week.
Sourced by Joseph Goslan, I believe.
See, exactly. They're managing principal in Eureka Business Group.
Mm.
This newsletter is this carefully curated cross-section of commercial real estate opportunities across Texas and Oklahoma. And our mission today is to, well, reverse engineer the underlying strategies here. Like, how do sophisticated investors actually extract alpha from these everyday properties?
It's the perfect lens for this, really, because a curated list like EBG's strips away all the market noise.
Hmm.
We aren't just looking at every random property on the market. We're looking at specific assets where a professional operator has already identified clear inefficiencies or, hidden leverage.
So let's start right at the entry level.
Mhm.
What this newsletter categorizes as the sub $2 million tier.
What jumps out immediately to me is that at this level, an investor's primary weapon is often structural creativity rather than, just writing a massive check.
Right? Capital isn't everything at that stage. Take the exclusive EBG listing in McKinney, Texas, for example. It's a 2,900 square foot medical and office space. They advertise that it's selling below county assessed value. But wait, if it's selling below the county assessed value, isn't that a massive red flag? Why is this highlighted as a top value pick?
I mean, it sounds like a trap, right? But the real focal point there is the availability of owner financing.
Okay, so the financing structure is the actual play.
Precisely. That financing structure is the entire play. When you bypass traditional commercial lending and negotiate directly with the seller to hold the note, you are fundamentally altering your cash-on-cash return.
Because you're not dealing with a bank's red tape.
Exactly. You sidestep the rigid debt service coverage ratios that banks demand, you avoid heavy origination fees, and you can often negotiate amortization schedules that a conventional lender would literally laugh you out of the room for.
Wow. So it accelerates the velocity of the investor's capital. They deploy less cash up front and keep their flexibility. I see a different application of that same force appreciation mindset in the Roanoke, Texas listing.
The industrial flex space.
Yeah, the 16,800 square foot one. EBG specifically notes it features short-term leases. Now, in a vacuum, high turnover or impending vacancies sounds like a nightmare cash flow risk. But they position this explicitly as a value add.
Right, because a short WALT, that's a short weighted average lease term, is essentially a blank canvas for an aggressive operator.
How so?
Well, think about it. If you inherit tenants who are locked into 10-year leases at below market rates, your hands are completely tied. Your capital is trapped in an underperforming asset for a decade. But if the leases roll over in, say, 6 to 12 months, you can immediately execute a turnaround.
You clear out the underperforming tenants.
Exactly. You do a light aesthetic repositioning, maybe some fresh paint and paving, and you sign new leases at current 2026 market rates.
That makes a lot of sense. And there was a secondary detail on that Roanoke property that caught my eye: leasable outside fenced storage.
Oh, that is such a classic move. That's the monetization of dead space. From a valuation standpoint, every extra dollar of net operating income you generate from a previously unmonetized dirt lot is multiplied by the cap rate.
So it's not just extra pocket change.
Not at all. If you generate an extra $20,000 a year just by leasing out that fenced yard in a 7 cap environment, you just forced nearly $300,000 of artificial equity into the asset. And you didn't even pour a single yard of new concrete.
That is wild. Which is a stark contrast to the Denton, Texas listing in this exact same under $2 million tier. It's a 3,500 square foot retail outparcel on the Loop 288 corridor, but the asset isn't really the building itself, is it?
No, the asset is the corporate AT&T guarantee. You are shifting from real estate risk to corporate credit risk.
It's like buying a safe government bond that's backed by a massive corporation.
Right. With a corporate guarantee like that, you're effectively buying corporate paper that just happens to have a roof on it.
And EBG notes similar dynamics with the Fort Worth and Georgetown retail centers, both heavily featuring NN leases. And assuming you, the listener, already know the basics of a triple net lease, what really strikes me here is the yield compression.
Investors are totally willing to accept a slightly lower cap rate on these NNN properties, right?
Exactly. Precisely because they are buying operational passivity. They are outsourcing the capex risk, the roof, the HVAC, the property taxes, directly onto the tenant's balance sheet.
They're buying back their own time, basically, and protecting their margins from sudden operational shocks. It's a strategy of capital preservation over aggressive growth.
So as an investor scales up, moves out of that scrappy value-add phase, and starts looking for heavy stability, we hit the next tier in EBG's breakdown, the $2 to $5 million sweet spot.
This is where it gets really fun. This is where the behavioral psychology of the tenant becomes the actual product.
And that psychology is heavily tied to the physical build-out, right?
Oh, completely.
Just look at the Saginaw, Texas listing. It's a 20,000 square foot building, 100% leased to Planet Fitness. And EBG specifically describes Planet Fitness as a large format, sticky tenant. The sheer scale of what it takes to open a massive commercial gym is basically the investor's ultimate insurance policy.
Yeah, let's look at the infrastructure required for that. A gym requires heavily reinforced concrete slabs to handle the weight of the equipment and the constant kinetic impact of people dropping weights.
Plus the locker rooms.
Exactly. It requires massive plumbing trenches cut directly into the foundation for those showers, high-capacity HVAC systems to handle the humidity and body heat, and, highly specialized electrical grids. The tenant is sinking millions of dollars into a bespoke infrastructure that cannot be easily ripped out.
So the switching costs are just astronomical. They aren't going to pack up and move to a new plaza half a mile down the road just to negotiate a slightly better price per square foot. Their own capex creates this extreme inertia.
And that inertia is what the investor is actually underwriting. You're buying the mathematical probability that the tenant will simply renew their lease out of sheer financial and logistical necessity.
Yeah, that concept of tenant behavior takes another really interesting turn when we look at foot traffic.
Yeah.
EBG highlights a Richardson, Texas retail center relying on built-in traffic from a neighboring venue called Truck Yard.
Oh, yeah.
And even more prominently, a Jack in the Box in Round Rock near Austin that is explicitly described as HEB shadow anchored.
The shadow anchor strategy is, hands down, one of the most efficient forms of real estate arbitrage.
The way I conceptualize a shadow anchor is it's kind of an indie band setting up their merchandise booth right outside the gates of a massive stadium tour. You capture all that high-intent, high-volume traffic without actually paying the stadium to be on the official ticket.
That is a brilliant analogy. That is exactly the dynamic at play. An HEB grocery store generates incredibly high-frequency, recurring daily trips. If you own a space inside the formal HEB plaza, you are paying exorbitant common area maintenance charges, CAM charges, to support the ecosystem that HEB created.
But if you're the Jack in the Box...
Exactly. If you own the Jack in the Box sitting on an adjacent parcel that shares a cross-access driveway, you are in the immediate gravitational pull of that grocery traffic without being subject to the anchor's operational constraints or their premium lease rates.
It is brilliant foot traffic arbitrage. But staying in this mid-tier, there's a listing that I seriously question from a macro perspective.
Each one.
The Taco Casa in Broken Arrow, Oklahoma.
Okay, what's the red flag for you on that one?
So EBG highlights a brand new 2026 construction with a 20-year absolute NNN lease featuring 10% rent increases. On paper, 20 years of absolute guaranteed yield sounds great, but locking into a fixed 10% bump schedule over 2 decades feels like taking on massive duration risk. I mean, if we enter a period of prolonged, sticky inflation, that fixed 10% increase could mean your real yield gets absolutely crushed by year 15. If you're locked in for 20 years, who's actually winning that deal? Are you not just betting against inflation at that point?
You are touching on the absolute central tension of long-term net lease investing right there. You are entirely correct that a fixed bump schedule exposes the landlord to inflation risk over a 20-year horizon.
So why do it?
Because the investor buying that Taco Casa is making a deliberate trade-off. They are exchanging inflation protection for absolute credit certainty and zero management responsibilities. It is functionally a bond substitute.
Oh, I see.
The bet isn't necessarily that inflation will stay perfectly flat. The bet is that the underlying absolute yield will still meet their portfolio's baseline requirements, even if macroeconomic conditions fluctuate.
They're trading the upside ceiling for a concrete floor.
Precisely. They know exactly what their downside looks like for the next 2 decades.
Well, if we want to talk about actually solving that inflation risk, we just need to scale up to the heavyweight tier. EBG's 5 to 10 million plus category is where the institutional mechanics really take over.
The financial structuring at this level becomes incredibly sophisticated.
The Houston, Texas listing is the perfect counter to the Taco Casa duration risk. It's a 41,126 square foot property, 10 million plus, housing an EPA federal lab. It has an 8.25% cap rate. But the key here is the lease structure includes CPI-based rent growth plus step-ups in later years.
And that right there is how you hedge the macro environment. By tying the rent escalations directly to the consumer price index, the lease dynamically adjusts to the inflation curve. The real yield is protected.
And we talked about sticky tenants with a gym, but an EPA lab.
Oh, it's on another level.
The bespoke environmental controls, the air filtration, the hazmat disposal protocols, like a custom-tailored suit. That build-out makes a commercial gym look like a sandbox. The tenant is permanently locked in.
The switching costs are virtually insurmountable. You are housing highly regulated government infrastructure. They're not moving.
Now, in this same heavyweight tier, there are 2 properties that require us to look past the top-line numbers. A 30,296 square foot retail center in Katy, Texas, and a massive 104,106 square foot center in Brownsville, anchored by a main event.
Okay.
EBG lists both of these as fully occupied or 100% leased. Yet, the Katy property is explicitly called a value add, and the Brownsville property advertises upside. Let's unpack this. If the building is completely full, how on earth do you make more money off of it?
Let's break down the Katy property first. EBG notes it is a value add with below-market rents. This is the classic mark-to-market strategy.
Right.
Katy has a highly affluent demographic like 150K plus household incomes and rapid geographic growth. The leases currently governing that 100% occupied center were likely signed 5, maybe 7 years ago.
So the spread between what the tenants are currently paying on their old contract and what the 2026 market commands is massive.
Exactly. The value add doesn't require finding new tenants or doing a physical renovation. The upside is realized entirely on paper. As those legacy leases roll over, the investor aggressively marks the rents up to current market rates.
So you are capturing the demographic growth that occurred over the last lease cycle?
Yes, and EBG notes this exact same mark-to-market upside on the Garland, Texas listing as well.
That makes perfect sense. The value is trapped in the contract spread. But the Brownsville property upside is physical, isn't it? EBG lists pad site development upside.
Oh, this is a masterclass in zoning arbitrage. When you look at a 104,000 square foot retail center, what you were really looking at is an ocean of concrete parking.
Right, acres of it.
Decades ago, zoning laws often required incredibly high parking ratios, say 6 spaces per 1,000 square feet of retail, but modern municipal codes, acknowledging changes in consumer behavior and ride-sharing, well, they often only require 4 spaces per 1,000.
Which means the current property is technically overparked according to modern code.
Yes. That excess concrete is legally developable land that you already own. An operator can carve out a corner of that parking lot right near the main road, a pad site, and establish a ground lease with a national drive-through chain or a bank branch.
So they're building a brand new asset on zero-basis land. The acquisition cost of the dirt is effectively zero because it was already baked into the purchase of the main center.
You are conjuring a highly lucrative, standalone NNN income stream out of thin air simply because you understood the local zoning math better than the previous owner.
That is brilliant, and it perfectly transitions us to the overarching theme of this entire EBG newsletter, because slap in the middle of all these lucrative multi-million-dollar listings is this massive warning graphic. It says, buying DFW retail from out of state. Avoid costly mistakes with operator-level experience.
It is the reality check that grounds everything we've discussed today.
It makes me think of playing a competitive video game on a TV with a 5-second lag.
Right.
If an out-of-state capital group is sitting in New York, looking at a spreadsheet of a Dallas property, they're operating with severe lag. The spreadsheet shows a great cap rate and a solid WALT, but it doesn't show that the local city council just approved a new median on the highway that will completely kill left-turn access into that specific plaza.
Exactly.
The spreadsheet doesn't reflect reality until the damage is already done.
In commercial real estate, the market is notoriously inefficient. Information asymmetry is where the actual alpha is generated. The local operator knows the traffic patterns, the sub-market consumer shifts, and the municipal zoning changes months or even years before that data aggregates into a national reporting platform.
And I think that context explains the rest of Eureka Business Group's footprint in this newsletter. They highlight their establishment back in 2008, their active leasing deals, like there's an industrial space in Anna, Texas they feature, but they also heavily promote their media apparatus.
The podcast and the newsletter.
Yeah, the Commercial Real Estate Deep Dive podcast, which aired on April 24th, 2026, and a LinkedIn newsletter. Why does a brokerage need a podcast, a LinkedIn newsletter, and weekly curated emails? Are they selling real estate or running a media empire?
Well, it functions as a public ledger of their market literacy. In a highly localized, high-stakes asset class, content isn't just marketing, it is proof of work.
Proof of work, I like that.
By curating these specific deals and dissecting the structural nuances of the DFW market on a podcast and executing live leases, they are demonstrating in real time that they possess the local alpha. They are proving they can spot the shadow anchors and the mark-to-market spreads before the broader market catches on.
They're essentially saying, we can read the terrain, here is the proof, now let us guide your capital.
Precisely.
So pulling all of this together, the major shift in perspective for you, the listener, today is how you view the built environment. When you look at commercial real estate, you cannot just look at the bricks, the mortar, or the roofline.
No, the physical structure is just the housing for the financial mechanics.
Right? Investing in commercial real estate isn't just buying a building. You are analyzing capital efficiency. You're evaluating the CapEx requirements that create sticky tenant inertia. You're looking for foot traffic arbitrage through shadow anchors, hedging duration risk with CPI index leases, and hunting for zero-basis land through local zoning nuances.
It really is an invisible web.
The next time you sit at a red light and stare at a strip mall, you won't just see a grocery store and a taco shop. You will see the invisible financial web of contracts, behavioral economics, and strategic leverage connecting them all together.
It is a completely different matrix. And, if we take that logic to its absolute extreme, it leaves us with a really fascinating theoretical question to mull over.
What's that?
Well, if a physical property's true valuation is entirely dictated by the specific terms of a paper lease, the macro inflation indices, the zoning codes, and the foot traffic generated by its neighbors, do commercial investors actually own a physical building at all?
Well, wow.
Or do they simply own the relationships happening in and around it? Are they just owning a node in a highly complex behavioral network?
That is a phenomenal, provocative question to chew on the next time you drive past your local retail plaza. Thank you for taking this deep dive with us today.